Right, let's just jump straight into this. Welcome back to The Explainer. Today, we're basically playing financial detectives, and we are opening up the books on Northeast Bank, ticker symbol NBBN. Recently, this bank didn't just report their fiscal Q3 2026 earnings. They absolutely blew the doors off expectations. We're going to unpack exactly how they pulled off this record-breaking performance, look under the hood at the real mechanics driving their profitability, and ultimately figure out what all this actually means for the stock's valuation right now.
So here's our game plan for today's explainer. First, the Q3 earnings blowout. Second, the margin expansion machine. Third, asset quality and balance sheet. Fourth, the 7.3% valuation gap. And fifth, key risks and takeaways.
All right, part one, the Q3 earnings blowout. Let's get into it.
Okay, take a look at this massive number right here, $3.53. That is Northeast Bank's Q3 diluted earnings per share. And to put that into perspective for you, the analyst consensus was sitting down at $3 flat. So what does that actually mean? It means Northeast Bank crushed market expectations by a massive 17.7%. I mean, in the banking sector, beating consensus by almost 18% in a single quarter is a total shocker. And as you'd probably expect, it immediately sent the stock price flying in after-hours trading.
But to really understand how they pulled this off, you kind of have to understand that Northeast Bank is not your standard run-of-the-mill local branch. They actually operate this really powerful dual business model. So on one hand, yeah, they are a regional community bank up in Maine. But on the other hand, they run this national lending division that originates and buys commercial real estate loans all over the country, specifically focusing on, complex credit structures. Plus, they've got a nationwide Small Business Administration, or SBA segment. This dual engine, bringing in local deposits and churning out national higher-yield loans, is exactly what just pushed their total assets past the $5 billion mark for the very first time.
And hitting that $5 billion threshold, it had a brilliant impact on their bottom line. Just look at this stark year-over-year jump. In Q3 of 2025, they brought in $18.7 million in net income. Flash forward just 1 year to Q3 2026, and that number has skyrocketed to $29.9 million. That's just an absolute surge in profitability. But, it sets up our central mystery for today. In a really complex interest rate environment, how exactly did they manufacture that kind of profit growth?
Which brings us to part two, the margin expansion machine.
So financial analysts covering the stock have been pointing out that the broader market might actually be severely underestimating just how structural this outperformance is. I love this quote. One analysis perfectly described Northeast Bank's model as a spread creation machine. Basically, they have this solid base of high coupon assets, meaning loans paying them high interest, and those reprice really slowly. Meanwhile, the interest they're paying out on deposits is still catching up on the way down. Long story short, they're locking in high returns while managing their costs incredibly well.
Let's actually look at how this builds directly into their core metrics. Check out the interest rate spread. That's literally just the difference between what they earn on loans and what they pay out on deposits. It widened from 3.96% last year to a super healthy 4.56%. But even more impressive is their net interest margin, or NIM, which expanded from 4.62% to an incredibly robust 5.15%. Honestly, in banking, NIM is the heavy lifter. Any margin above 5% is absolutely exceptional, and it's the main engine behind those record-breaking earnings we were just talking about.
All right, moving on to part three, asset quality and balance sheet. Now, high margins usually imply high risk, right? So the absolutely crucial metric we need to look at is this one right here, 0.78%. That represents their non-performing assets as a percentage of total assets. Look, when a bank grows its loan portfolio as rapidly as Northeast Bank has, pushing total loans to $4.56 billion, you generally expect to see some bad loans pile up. But at just 0.78%, their asset quality is sitting there looking remarkably pristine. They're growing aggressively for sure, but they are clearly underwriting those loans with a really strict focus on safety. And because they're generating these high margins while keeping bad loans to an absolute minimum, their efficiency is just off the charts. The return on average equity for the quarter hit 21.67%. To put that simply, it means that for every single dollar of shareholder capital management holds, they're generating almost 22 cents of profit. That's up from 16.47% the previous year, which really proves management is operating a highly optimized capital allocation machine.
Let's shift gears to part four, the 7.3% valuation gap.
So we've established their historical performance is stellar. But how is the market actually valuing this right now? Well, despite a massive run-up in the stock price, which by the way gave investors over a 50% total return over the past year, there might actually still be room to run. Recently, the stock was trading around $132.48, but the prevailing consensus fair value out there pegs it at $136.50. This creates a pretty fascinating scenario where despite the blowout earnings and all that strong momentum, the stock might still be trading at a 7.3% discount to its fair value.
But hey, fair value is just a mathematical narrative, right? It's built entirely on assumptions. To actually agree with that $136.50 price target, you have to buy into a very specific version of the future. You have to believe that by 2029, Northeast Bank's revenues will scale up to $362.5 million and earnings will hit $164.1 million. You also have to assume the market will value them at a relatively modest price-to-earnings ratio of 8.7x, using a discount rate of 7.34%. So the real challenge for you as an investor is deciding, are that faster revenue expansion and those thicker margins truly sustainable over the next 3 to 4 years?
Finally, Part 5. Key risks and takeaways.
Whenever we weigh the scales on an investment, we have to look at both sides. Now, the bullish momentum here is undeniable. You've got incredibly thick margins, over 5%, low non-performing assets well under 1%, and a highly profitable national commercial real estate strategy. But on the bearish side, reality presents some clear headwinds. The bank is facing risks from higher technology spending, and that might not yield any clear immediate payoffs. On top of that, their SBA small business lending volumes are facing some pressure right now from regulatory headwinds and stiff competition from bigger institutions. Remember, it's a dual model. The commercial real estate side is absolutely booming, but that SBA side is going to require some careful navigation.
So, bringing it all together, Northeast Bank just delivered an absolute masterclass of a quarter. They crossed $5 billion in assets, crushed earnings estimates by nearly 18%, and proved that their spread creation machine is firing on all cylinders. But as we know, investing is always about the future, not the past. So I want to leave you with this final thought to guide your own analysis. Given those regulatory risks and the incredible run the stock has already had, is the 7.3% valuation gap a wide enough margin of safety for your portfolio? Dig into the numbers, weigh the risks, and make the choice that aligns with your strategy. Thanks so much for joining me on this explainer, and I'll catch you next time.